This specific example is about small intentional moves, and here's what the modeling shows us. They lower their lifetime taxes by over $114,000. They eliminate all future Medicare IRMAA surcharges, and they gain significantly more control over how and when they take their income in retirement. Hi, I'm James Clark, the Wealth Management Director with Blumark Tax Advisors. When most people think about retirement planning, they think about market performance, stocks, bonds, total returns. But one of the biggest forces shaping retirement has nothing to do with the market at all. It's taxes. And how your money is positioned for taxes can determine how much of your lifetime savings you can actually get to keep. That's where the idea of building diversified tax buckets comes in. It's the tax version of having balanced investment portfolios, giving you options, flexibility, as well as control. The three tax buckets we use at Blumark Tax Advisors are simple and straightforward. The first we're going to take a look at will be taxable accounts. So those are accounts we are going to have taxes paid in the year that you earned the income or saved the income. And as you go, you'll end up paying taxes. These are investments like checking accounts, savings, brokerage accounts, CDs, as well as real estate. If we look over to the right on the lower side, we have tax-deferred accounts. All of those accounts you get a tax break today, but withdrawals later are fully taxable to you. These are your 401k plans, 403bs, 457s, traditional IRAs, as well as pensions. If we move up to the top, this bucket is our tax-free accounts. In our tax-free accounts, you pay taxes up front, but the withdrawals later in life can be completely income tax-free. Examples of these assets include Roth IRAs, cash value life insurance, and municipal bonds. Health savings accounts are close to this group because withdrawals for medical expenses are tax-free, but unlike the others we talked about in the tax-free bucket, you actually get a deduction when you make your contributions into a health savings account. So what we tend to run into is a lot of folks end up being accidentally tax deferred. Most people end up with the majority of their savings in the tax deferred accounts down on our lower right. And that's understandable. These accounts are great for long-term accumulation and for saving taxes today. They create a problem later, though. Almost every retirement draw becomes taxable income. This means higher taxable income, possible higher tax brackets, potential for increased Medicare premiums, and ultimately less control for you. The accounts that helped you build your wealth can limit your flexibility if you only have one kind. And we would say that's true of any one of the three. We just tend to see more people build excessively in the tax deferred bucket. So let's take a look at a real example. Let's say we have a client who is earning about $200,000 a year. They have 1.1 million in pre-tax retirement accounts. And if they do nothing, every single dollar in retirement they spend will become taxable as those withdrawals come out. Let's say, for example, this same couple, 48 and 50 years old, starts gradually Roth converting. Let's say they convert $15,000 a year, so $7,500 each, and we're going to go from pre-tax accounts into Roth IRAs every year over the next 10 years. The objective here is to have small, steady moves that'll ultimately have a big impact. This isn't about massive conversions or creating really big tax bills. It's about small, intentional moves. And here's what our modeling ends up showing us. You can see in the light blue bars at the very bottom, is our base case where we're doing our ordinary income taxes. And then the light darker blue ends up being our Roth case scenario. As we look at the screen, you can see the lighter blue is the base case scenario. So that's no Roth conversions, where our darker blue is going to have the Roth conversions included. And you can see we have a little bit higher taxes for the next decade. Our dark blue bars are a little bit higher, But in the future, we end up with less taxes coming out. So our lower bars, the dark blue bars, end up being lower. And here's what it ends up showing us. Over this couple's lifetime, they save over $114,000 in taxes. Additionally, and we're not going to spend a lot of time on this, but they do end up eliminating all future IRMAA surcharges on Medicare. But more importantly, they end up significantly having more control over how and when they take income in retirement. They didn't necessarily save more. They didn't change their lifestyle. They simply reposition some of their savings gradually. Having a diversified tax bucket strategy gives you really three main things. It gives you control, so you get to choose which bracket you draw from. The second area is flexibility. Tax-free withdrawals can be taken in your higher income years. You can take out taxable accounts for liquidity purposes, and you can use tax-deferred accounts strategically. So you have some flexibility because of the different pots. You also have tax efficiency, so reduce risk for higher future tax bills and ultimately Medicare surcharges. Instead of being forced into whatever the IRS requires you, you get to stay in the driver's seat. We didn't even mention required minimum distributions, but that is really where a big chunk of the tax savings and the IRMAA savings come in as well, because we're not subject to required minimum distributions on Roth IRA accounts. Retirement planning isn't just about investments. It's about control and keeping more of what you've spent your entire life building. You don't need to do a dramatic overhaul. Small, steady steps like modest annual Roth conversions can meaningfully reshape your long-term tax picture and create real flexibility. If diversified tax buckets resonate with you, the next step is simply getting clarity on what your personal numbers look like. No pressure, just understanding your options and taking control of your future.